Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Hello there. Welcome back from the world between worlds for those of you who have been watching the Ahsoka series. If not, well, you won't get it. Check it out. We were going to bring you the Russ Colitis interview this week, but the good folks in compliance took a bit longer to review that. So that's on tap for next week with Russ talking through option income strategies, downside protection, and even capturing S&P upside. And then we're recording our live event in Philly for the pod. So go subscribe on your favorite pod platform today to get those new episodes dropped into you automatically. On to this episode where I got to sit down with two old friends in this business, Bryan Kiernan and Emil van Essen of Katonah Eve. We talked through their journey from spread broker to spread trader to spread hedge fund, and what it's like being big, what it's like being small, and then dig into their long-short commodity program, which tackles commodity trading in a unique way using the term structure to identify coming market moves. Oh, and we also chat energy, crypto, and China. Send it. This episode is brought to you by RCM's China division, where we help Western asset managers access Chinese assets using Chinese futures markets, as discussed a bit in this pod. Visit rcmalts.com/China for more information on how all that works. And now, back to the show. Welcome, guys. How are you guys?
Fantastic.
Great. Bryan, I got to ask what happened to the wing there?
Well, started a new career in mountain bike racing and blew a tire last week and broke my hand. So,
whoa! Actual racing? You weren't just riding for fun?
Well, I've been riding for fun, and I've started to take it to the next level. So,
nice.
Yeah, and with that, I'm learning, and when you learn, well.
Your new career lasted as long as Aaron Rodgers?
Yeah, about the same, right?
A little longer. Did you make it around at least? How does it work? Is that laps?
Yeah, they it's lap times, and so I've been out of the races I've been doing have been about 100 riders, and I'm about middle of the pack. It's my first season, and but I'm only going to be out for, they think, unlike Aaron Rodgers, maybe 6 weeks. So not season ending. And so, yeah, I hope to be back out on the trail soon.
Perfect. Wait, is Aaron Rodgers out for the season?
Yeah, he had 4 snaps last night.
Yeah.
And then his Achilles blew. So listeners, and we're recording this on Tuesday, September 12th, the day after that game. Yeah, I don't know what they paid him, 100 million or something for 4 plays.
Yeah.
Zero completions. Whoops. Anyway, and Emil, you're here in Chicago for now?
Yes, I am. Until mid-October.
And where do you do those? Bryan, you moved down to Kentucky, right?
Yeah, so just
the hills of Kentucky.
Yeah, northern Kentucky, just outside of Cincinnati.
Awesome. So people probably didn't come here to talk about mountain biking. So even though it's interesting. Peter Sagan, do you know?
No.
Tour de France guy, and then he tries to compete in the Olympics in the mountain bike race.
Okay.
So that's all we'll say about that. We've known each other forever. It seems like been in this business for a long time. So just wanted to kind of have you guys give the Cliff Notes version of how it got started, kind of ran it up big, hired some institutional people, came back, downsized into the smaller group, launched some new programs, merged with another group. So you've kind of been all shapes and sizes and pieces of this puzzle for what's it been, 20 plus years? So
that's right.
Yeah. So someone start and we'll dig into that journey that you've been on.
Yeah. So we started really as a brokerage firm, an IB, and started developing programs. I mean, that was sort of my thing. I'd come as a bank trader a long time ago, Bank of Montreal, and started developing programs, and eventually developed the spread program in 2006 to trade commodity spreads. And that looked pretty exciting. It was a time at which commodities were growing dramatically, and that program really took off. We averaged over 30% a year for 5 years. And, the assets grew as commodities became more popular. So we built that to almost $500 million in over the course of, until 2012. Then the people, the long only commodity funds started changing their behavior a little bit, started trying to make it hard for us to make money off of their backs. And so the space started shrinking. A lot of the big institutions started pulling back on their commodity allocations. And so that program kind of shrank, and we shut it down a couple of years ago because we weren't seeing the kind of alpha that we used to see way back when. So
And
that was the history.
was it as simple as the like Goldman roll trade? I know it
Well,
wasn't, but that was the genesis of it.
yeah, so the start was looking at, all the long only funds, which totaled a couple hundred billion, were rolling from one month to the next, and they were doing it in a very consistent way. So we could easily get in front of how they were moving their money. And we knew everybody else who was front running it, and we essentially were front running the front runners. But through all the trades we did in spreads, we started doing a lot of testing and developing systems to trade spreads as well. So we started merging the two, front running the Goldman role, as they'd say, and then just trading spreads. So we found a lot of unique opportunities in commodity spread trading, and that's what we did for a number of years.
And Brian, were you guys using the spread price, its own data set, or were you looking at each market separate and then calculating you wanted to be long this market, you wanted to be short this market, and it created a spread?
Well, I mean, at that time, data wasn't as readily available as it is now. So we were pulling in data from a variety of different sources, creating our own proprietary spread databases, building our own contracts. Now it's a little easier to get that data, but I feel at that time one of the things that gave us a competitive advantage was being at the advent of electronic spread trading. Being able to have the forethought to realize that was the direction that markets as a whole were moving to, that being electronic trading, and that was probably a byproduct of being in the brokerage business and being in the financial technology business. And so, many of the tools that we were building for the CTA, were part of that data aggregation process that we were using within brokerage and the financial technology business. And it all was kind of fitting together, that we were finding that nobody else was doing that at the time. And we found ourselves with a set of data that nobody had. And that allowed us to develop different strategies beyond the roll trade on spread data. And I think that really allowed us to stay ahead of folks that were trying to gain entry to term structure trading. And we've always tried to kind of just stay ahead of the game as it relates to term structure trading, and that's part of data construction.
Were any of the banks who had those long only programs front running their product team off the record, even though we're recording?
I wouldn't be surprised if Goldman's trading group was front running their own
right? Yeah, it seemed
GSCI, but I don't know firsthand. I know that the guys who are running the long only commodity funds were pretty afraid of us front running them, and they would ask to talk to me, and then Newsweek wrote an article about it and that was kind of stupid on my part to actually,
You
you
went
know,
on
say.
in the article.
I went on record as saying, we try to get in front of the dumb money, and they
They're
made
like,
it. They made a big point of that. So that
we'll show
probably
you
was,
who's dumb, right?
yeah, exactly. They kind of changed their strategy and
But it seemed like they
shrunk.
had to change anyway, right? Because these ETFs were poorly constructed, just the constant roll, and they were losing the quote unquote roll yield, right? So it seems they kind of had to move to a like average of 3 months or 6 months or whatever.
Yeah, but don't forget, like in the mid 2000s, everybody wanted into commodities, and everybody wanted. So people came up with these formulas, and they came up with a standard way of rolling. So eventually, then people evolved and changed. The institutions changed their strategy, but in the early stages, they just wanted the exposure, and they wanted it to be well defined. So that's what they got, and that created an opportunity for us to make money off of. And then we evolved too. So we
Yeah.
evolved from just front running the rolls to trading spreads, and
And
that
then,
was profitable.
and let's clear up, there was nothing illegal about front running, right? Because you didn't know the orders. You're assuming the orders or assuming the rolls, right? It has a negative connotation, front running, but
Yeah, and I don't think there wasn't any inside information involved. I mean, we
right.
basically mapped out where the market was when it was shifting from one contract to the next. And by the way, they published it too. They
Yeah.
published the dates at which they were rolling. So
Well,
it
and
was
firms do
it was
this now, and like someone gets added to the S&P, and they believe it's going to be this group, right? And they start to buy up that stock and sell the one that's going to get dropped. And
and that
um,
hasn't worked so well over the last few years.
and
Front
then
running the S&P inclusions.
why commodities? Just that was your background. That's what you knew well.
No, I would say that was the whole development in the mid 2000s was commodities started getting big and people started using it as an investment vehicle. So it used to be something for producers and consumers, the commodities, but then all of a sudden in the mid 2000s, commodities became like an investment tool, which
Yeah.
is kind of strange in a way, and it really made commodity prices go higher than they should have because all of a sudden you had hundreds of billions of dollars worth of investment capital going into these commodities as an investment and basically driving up the price. And so we were just going with the flow, like following the money, and that made sense at the time.
How much do you think that's come off of? You'd still come across investors who have like a stated 3% allocation of commodities or 5% just a long only commodities. It still
Well, I
exists,
think,
right?
yeah, it still exists. What happened is a lot of pension funds, I think, moved to like actual hard commodities or commodity assets like land
Timber.
or even equities and stuff like that. I think there was a big decline in the amount of money uh, sitting in futures in a long only program.
Um, and then somewhere along the way there, you guys started bringing in some other traders, doing some different types of trading in-house. What was that evolution? Brian, you want to
Yeah,
take that
so
one? Or sorry, go ahead. I mean,
no, I mean we expanded what we were doing. I mean, we were doing well and we were kind of a force in commodities. So we started doing market making and calendar spread options. We started hiring people with fundamental knowledge of, let's say, the energy market. We were just building as a company.
Yeah, I mean, I think
Um,
that one of the big things that we had going for us at the time was, not only a good stable strategies, but operationally we were, I think, we were best in class. We were institutionally digestible, and with that, we could provide infrastructure to incubate other
mm,
managers and then add that as a diversification to the business. And for that, that made a lot of sense because it's, as we know, it's not cheap to operate a business, and we had the infrastructure to do it. And so we wanted to incubate these managers and bring them to market. And some were complementary to existing strategies, and others were, uncorrelated and could provide our investors with other uncorrelated asset streams.
It's like a pod shop before it became known as a pod shop. A bit.
Essentially.
Yeah. So on the screen behind you, Katonah Eve, right? So the firm was for a long time, Emil van Essen. I don't know where you came up with that name. And now Katonah Eve. So how did that go down? What was the logic behind that merger? Is it fair to say merger or joining, whatever it was?
Yeah. So I had been in touch with Alex Lorero for a number of years at Katonah Capital Partners, and they had a rip roaring track record for a number of years, and had seen massive asset growth quickly to 600, much like we did. And so we had been sharing notes operationally as to how to avoid certain pitfalls with that type of rapid asset growth, and became friends. And at some point in time, back in 2020, 2021, we started talking about maybe it had, would make sense to get together and do something. And so the conversation started, and I think that the first conversation that, Emil and Vivian Oberoi, that was kind of where we thought that it really made a lot of sense, because, those guys are I tend to lend myself more to the business development and ops side of things. And Emil is always kind of the mad scientist, if you will, and strategy guy. And Vivian is, the guy that is able to implement these ideas via research. And so the ability for Emil and Vivian to play in the sandbox together made a lot of sense for the firms to get together.
Plus, they lost Katonah Capital Partners lost one of their partners. He was having medical problems and bowed out, so they were down to two partners, and they thought it was necessary to expand a little bit by joining us. And then when we saw the synergies, we did it. We just put it together.
Love it. It's been good so far.
Yeah.
You get to play in that sandbox. How do you like the sandbox?
Oh, for me, I like it because, Vivian's really good at doing all the dev work, the quant work, and I come up with the ideas and he does the coding, and it's very productive that way.
There's no cat dirt in the sandbox? Every now and then
Always.
you leave some behind. Right. But that leads me into, well, first, yeah, I'll go there first. Right. Leads me into, I've always known you guys, right? Emil, we're talking at a cocktail event. You're like, well, I'm trying this thing in crypto, and oh, I'm doing this thing in the energies. And so some of those ideas you're not just testing, but you're putting your own money into. So I've always kind of admired how you're running this business, you're trading client money, but at the same time, you're running your own money and trying new things with your own money. So kind of, how do you view that evolution of it's hard to get rid of the trader in you and the piece that wants to make money on your own with your own ideas, these new ideas, kind of before you put clients at risk with it?
Yeah, so there's a constant search for alpha. I mean, I'm kind of an alpha junkie. I'm always looking for stuff that's sort of outside the box that generates a lot of alpha. So when you're trading oil, you tend to look at, what are oil producers doing, oil infrastructure, and I was like, look at some of these companies look pretty interesting. So you start looking at the companies and then maybe buy some and do something. Or, in the case of crypto, I just saw a lot of opportunities and just dove in, and, eventually you see more and more opportunities and you say, okay, I want to try something here. So it's just investigative. And it's the idea of just trying to find avenues that have superior alpha generation.
with the goal of getting that into client portfolios eventually?
Yeah. So what you're trying to do is the alpha real? Is it sustainable, and is it scalable? And if it is all those three things, then you want to bring it to investors.
And so does it take a special mindset to be like, I'm fine risking because you don't know the answers to those three questions, but you're putting your money to work, right? So I don't know if a lot of managers would do that, or they'd just test it to death and then bring it out to clients to risk, right? You're doing the other method of like, I want to see it with my own money first.
Yeah, so I think you got to test it out, and you have to vet it out. And I mean, how do you know how it really works unless you put your own money in first? And I'm perfectly comfortable with that. So,
Well,
and
it
maybe
helps
you
to
win.
have your own money first, right? Yeah.
Well, I
Some guys
guess it's
starting out might not have that luxury.
yeah, yeah. So maybe then you use other people's money, right?
Right.
Um, you know,
But but I think it's kind of always been that way, right? I mean, I think that it's even maybe from the very onset, right? When there wasn't that much money. I mean, I think it's kind of tough to sell something if you don't believe in it and you don't have enough conviction in it to kind of eat your own cooking. And I think Emil has always, had that philosophy, and that's kind of the way that he's, built the brand. And I think that, certainly from a business dev side, certainly makes it easy for me to pick up the phone and be like, well, we're trading it.
Right.
So, I mean, and I don't think that we've ever done it any other way, and I don't know how you can't really test something unless you're really trading it. So I think that our investors that have been with us for a long time understand that, and that's kind of always been the ethos for us.
Yeah, which I like. It's not just that you're eating your own cooking. You're eating like junk you're coming up with in the kitchen that gets burnt too. Right. So it's like there must be enough good stuff in there that you didn't just burn all your fingers off and your mouth is rotted out, right? That you're finding enough good stuff in all that process to make it through and not blow through all the money that you're using to test.
yeah. I mean, obviously, you got to use some caution in the
Yeah.
early stages, and then you build it over time.
You guys have had a newer program, long short commodity program that I wanted to talk about. We talked about commodities being big back in 07. They kind of got big again here in 22 with the inflation specter coming around. So tell me what you're doing with that newer program and kind of what the philosophy is, and then we'll dig into how it works.
So that long short commodities was actually developed almost 10 years ago. Um, and when we were doing all this work on commodity term structure, we realized that there's this really critical relationship in commodities between term structure and the outright price movement. And that you could use the term structure to really predict what outright prices were going to do. So if you wanted to predict where crude oil is going, just look at the crude oil spreads. And so we had developed this 10 years ago, and we had traded it for some customers. It had a bit of a drawdown in 2019, 2020. But I've traded it like I do with my own money since inception. And we and it really shot the lights out. It was making all kinds of money in 2021, 2022. Even in 2023, we're now at high watermarks, but it's a very unique way of approaching the market that I don't see other people using, and yet it's systematic. So, a lot of times commodity traders are discretionary fundamental and they trade one market and it's kind of boom or bust. But this is sort of a diversified approach of trading many markets systematically using this sort of unique predictor of term structure.
I'll throw in a quick past performance is not necessarily indicative of future results disclaimer there. Playing the difference between it and a normal trend following program that goes long and short different commodities?
Well, we go long and short, but most people use trend. So if the market's going up, they get long. If the market's going down, they get short. But we actually mostly look at the term structure behavior. So there's certain patterns of the spreads which tell you. So like tell you if a market's going to go up or it's going to go down. And those predictors are much better than trend. So while everybody's using trend, we think trend is actually kind of a poor predictor. If you look at the tops and bottoms of the market in 2008, when crude hit its top, the spreads were telling you there was going to be a turnaround like a month before the turnaround actually happened. And this is what we believe, that the spread actually is a good indicator of the supply demand in the market. And so it's the best way of really getting a handle on what the supply demand conditions are. And then you use that to trade. So it's something we worked on for years. We really believe in it. It's making money. It's holding on to the gains that it makes. And so we think it's the best way of trading commodities.
And by term structure, you're saying when it shifts from contango to backwardation, or you don't really care about the shape of the curve, but specific time points on the curve?
Well, we're looking at the shape of the curve and also the direction of where it's going. So we look at the trend of the curve, how it's moving. So there's shapes of curves that when there's a real shortage of commodities that show up in the term structure or the spreads. And then there's a different type of shape when a market's about to collapse.
Well,
So
we're
we
like,
have
you came on our when crude oil went negative, you came on the pod. We'll put that in the show notes. That was a good listen. But right, that's an extreme example of like this supply demand is so out of whack that the front month is actually going negative in crude oil.
right. So you had, you know, an extreme contango in that market, and it was telling, and you had it long before that, so it was telling you that there was going to be a problem in that market, and there was a massive oversupply. They couldn't get rid of the oil, and that showed itself in the term structure.
What's the risk profile look like? It's similar to a trend follower. Like, is it going to necessarily? Do you expect it to capture trends like in 08 and 22? Like, even if it gets there a different way, do you expect it to kind of have the same profile that investors expect out of managed futures and more specifically trend following?
So, like for example, in '08, it was amazing at predicting the turn in the market. So trend followers kind of got their face ripped off when the market reversed, but this kind of model picked it up exactly. In 22, you see a lot of people made money with the war in Ukraine and everything that happened. There was a lot of bull markets and people made money, but when they reversed, they gave it all back. But I think the term structure was able to predict that there was going to be a turn before it happened, and therefore was able to hold on to the gains. So very, very good returns in 21 and 22 when there was a lot of two-way action in the markets.
And Brian, is it just commodities?
Yes.
There's no bonds or currencies, or so that is a differentiator between your classic trend follower.
Yeah, we've had investors that like that return profile, and so we've kept it that way. And we're starting to see increased demand in people looking for commodity only product, and so we want to see that continue to grow. We feel that this product is going to be best in class for commodity only.
And is it always in the position, or no? It could be long, short, or flat.
Correct.
Yeah, so it has to have the right setup to have a position. So it can be long, short, or flat. So probably it's about a third, a third, a third.
And if I had to summarize it in one paragraph, would it be fair to say it's most likely going to give you most of a trend following exposure when there's trending markets, but capture those turning points a little more effectively?
Yeah, it'll capture the turning points, but it'll capture the trend as well. Yeah. And so you don't necessarily have if the market does a quick reversal, you don't necessarily give it all back. You can actually catch it right at the turning point. Not always, obviously, it's still the
Right.
markets, but it's much better
Right.
at
So
doing that than other programs.
the bad scenario is you kind of get these, it reverses down, then back up, reverses down, then back up, right? That you'd get whipsawed in that kind of scenario.
Right. So to give an example, I believe in June, um, crude oil was heading down, and a lot of people thought, we were going into a recession and crude was going to go lower, lower, lower. And all of a sudden, there was a big reversal in July, and there was a big up move, and a lot of people in the energy space got hurt badly in July. And we picked up on that and actually made a new high water mark, had a big up month in July, caught the move while a lot of people were getting hurt. So it's actually a good diversifier for sort of a lot of traditional players in the commodity space because it behaves so much differently.
We'd say that it's a great complement to traditional trend.
Yeah. So put it in the portfolio, have it be a diversifier, cover those sharp moves on the other trend followers. The weird part in 22, right, for trend followers, you're saying they gave it all back. Yes, in commodities, but right at that same point, they started making money in currencies and bonds. So as a portfolio level, it was kind of a smooth upward climb the entire year for quote unquote trend followers. But yeah, if you look under the hood, it was commodities first, then commodities reverse, and then bonds kind of carried the baton from there, which was a
So that
unique type of year. Usually you get it all reverses at the same time and they give back all the gains.
But talking specifically about commodities,
Yeah.
the issue is there's not very many good commodity systematic programs. And what you see in commodities is you get discretionary fundamental guys. So if somebody trades nat gas, or they trade grains, or they trade crude oil. And that is kind of a feast or famine approach. Like sometimes they just hit the ball out of the park and they make a fortune, and sometimes they blow up and are never heard from again. Uh, and it's a tricky proposition to get this mix of discretionary fundamental guys, and it's sort of a certain type of approach, so it doesn't capture everything. So we feel like this is a very different approach with very different results, and often more diversified and hopefully better results than you'll see with discretionary fundamental. And you just can't get that. It just doesn't seem like it really exists in a strictly commodity sense, to have a systematic program that works.
And does it work? Right. I think we'll come full circle now back to those investors who wanted to own those long commodities in those products, right? Because it was a simple premise. There's inflation, super cycle in China, blah, blah, blah. I want the commodity exposure as part of the portfolio, ignoring that commodities has huge drawdowns and tons of volatility. So I think all the investors would get, hey, this is a better way to access commodities, way less drawdown, way less volatility. The question is, can I still capture that if there's a super cycle, if there's a inflation move, am I still going to capture the upside in commodities? Right. That's the trick with investors. Like, okay, I get it. Is this if I put it in my commodity bucket, am I actually getting commodity exposure, or is it just an alpha source that uses commodities?
Yeah, well, I think it's like, drawing the analogy to cryptos, right? If the market has a huge bull market, you're gonna profit from that. And that's probably where you're gonna make the most money. But if the market falls apart, you actually can make money as well.
Yeah.
So the
But
problem
not
is,
by mandate. You don't have there's not 20% of the portfolio is long only. It's
no,
right by chance is the wrong word, but by, right, just the profile is it should capture those commodity moves.
and on average over time it will. And so that's the idea, that you make money in both directions, that you're not simply limited. Like some people might say in certain asset classes, you're better off just being only long.
Yeah.
But I'm not sure that applies to commodities because you do get these boom and bust cycles.
Or you see a lot of these long flat in commodities. Like, okay, I don't want to try and make money when it goes down, but I want the exposure, right? Instead of my 3-5% commodity bucket, I'm going to have 3 to 5% of the long side. But that's difficult too, right? If you might be flat at the wrong time, you might give up money of when you should have been short.
Obviously, you're going to see like all different styles, and the idea is to get the combination of managers that produces the best Sharpe ratio over time. And we just think that this is differentiated enough that it improves almost every portfolio. So there was actually somebody wrote a report on this that Brian, I don't know if you recall the name of the report, but they looked at
Was it
how
me?
additive. What?
I said, was it me? No. Yeah.
No, they wrote about how additive programs are to a managed futures portfolio. So that really goes to correlation and alpha, the combination. And this program was listed as the second highest in terms of being additive to the typical CTA portfolio.
Yeah. C-Warp.
Oh, Chris Cole, right. C-Warp.
Yeah. Mm-hmm. Our C-Warp for this program is a 27.
Nice. And I would argue, right, it's improve the MAR ratio instead of the Sharpe ratio, right? That is more, especially for managed futures and that kind of, right? Like, I don't think people care as much about reducing the volatility. They want, when there's a big upswing, when there's a big market crash, truncate my drawdown, right? So if you improve that MAR ratio, drawdown, return over drawdown, but I'll argue that all day and not get a lot of takers because everyone still cares about Sharpe the most. But I'm planting my flag in MAR. Yeah.
Right, but Sharpe usually you look at it on a manager by manager basis, but the idea is to create an efficient frontier that combines the right non-correlated managers to give you the maximum return and the lowest drawdown. And those
But Sharpe would be
programs,
the lowest volatility, not the lowest drawdown, right?
right?
Right. So that's what I'm saying.
You could look
I
at
want to do the
Sortino.
efficient frontier with drawdown. Yeah, Sortino instead of vol. I always kind of think of you as an energy guy. I don't know if that's fair or not. So just quick side note, what are you seeing? Energy prices, the energy environment, right? Everyone seems to think this move to greenflation, right? That it's actually causing energy prices to go up to get to where we need to be for all that stuff. Got any thoughts there quickly before we move on?
Well, I do think that, oil prices have been going up here. So we're at the $90 area. So when you get above 70, 80, up to 90, $100, essentially you're getting incentivizing a lot of development in shale and what have you. And so it tends to breed a lot of overproduction in time, and then that causes price to go down. So it's just an endless cycle. Um,
You think
will
even with rates here, and banks' willingness to fund those projects?
Yeah, well, investors
At
will
some number,
fund
it
them.
makes
I mean,
sense. Yeah.
the returns are there. Look at Warren Buffett; he's putting his money behind some of these energy drillers. So, and the oil infrastructure, I think, has very good returns. So all that's getting built, and it slowed down a little bit in this year, but I think with prices now going up, I mean, people are incentivized to do more, and eventually it takes its toll, and then shale starts taking market share from OPEC, and then OPEC gets upset and they flood the market with oil to kill shale, and we go through the cycle again.
It goes round and round.
Yeah.
It seems that all seems too simple, but basically that's what it is.
Yeah.
And then you mentioned crypto. Tell us what you're kind of doing in crypto real quick.
Well, we built a lot of trading strategies in crypto, but what we found is that there's a lot of managers out there, and with the the government started declaring war on crypto in the United States, a lot of these guys have lost their assets or, a lot of their assets. But there's a lot of good technology and a ton of alpha in crypto. So what I started doing is using my own money to allocate to managers who I thought looked good, doing managed accounts with them so I can observe their trading and trying to get a combination of traders that's really produces high Sharpe ratios for institutions. So you want a combination of short-term directional, which can make a ton of money in the right market conditions, and then market neutral, which doesn't make a ton of money, but makes consistent money with virtually no drawdowns. So by having that combination, you can get like a 5 Sharpe type of return. The problem is a lot of these guys have no compliance, their operations are poor, they just have a good strategy. So our idea is to make sure their strategy is good and then try to figure out how to put things together and get them more institutionally vetted out, so we can package it up for a pension fund or a big fund or a big allocator of any kind. So you got to remember, this is early. It's early stages in crypto, and it's not a mature market yet. And that's what, always in a growing market that's not mature, you get a big opportunity set, a lot of risks, but a big opportunity set. You can make a lot of money with people who have the right technology and the right ideas. And that's our job, to find that and to allocate the money appropriately and make sure that they have the right operations. But
And you
there's
think
real
there's
money
like
to be made.
you think there's like a half-life to that of like we can get these 5 Sharpes for the next X years until it matures and it catches up?
Well, I think you're gonna get some high Sharps. You're gonna eventually get a bull market again. And the bull market is going to produce crazy Sharps, high Sharps, and people are going to make a fortune. And then eventually everybody's going to pile in. We already see BlackRock, Fidelity, a lot of big players lining up, and then probably it's going to slip quite a bit.
Yeah.
So
Right. Cause the most pain to the most people. And
yeah.
I take a little offense, not offense is the wrong word, but like it's not that new of a market, right? It's been around for how many years? 15 years now? More?
Well,
So I get what you're saying. Like it hasn't, institutional money's not in there, and then trading isn't as mature as other markets. But like it seems a little bit weird of like, okay, we're still waiting for all this to happen, but we've been waiting for years and years and years.
Well, I think when we look at the way that the infrastructure is set up, right? And we compare it to TradFi.
Yeah.
Are there FCMs? Is there banking? Is there, administration? What does custody look like? All these things are different, and it's all being built. And it also is difficult in the sense that when there's unclear regulation, it does hamper the development and pace of development within those areas that I think that help make these infrastructure components mature in a more expeditious fashion. And that is what that when we talk about maturity, these are the things that I'm referring to. The markets themselves and the participants within the market, you have liquidity, and you have these coins that have been around for, Bitcoin's been around for a long time. But in the end, if you look at the age of the stock market or the age of the futures market, and electronic trading is only 20 years old, right? So, in comparison, I would say that it's still in very, very early days. And
don't forget, like crypto probably in 2017, 2018 was still absolutely in its infancy, with most companies were an absolute joke. So the institutional involvement has really only come in the last few years.
Right. But it's sort of a weird thing to be like, oh, this decentralized thing is really going to be something when it gets centralized. right? That's essentially what we're saying. Like once we put all these centralized pieces on top of this decentralized technology, then we'll really have something.
Well, I think
but
I think that there will be a happy medium there.
yeah,
That's what I think. And I just think that you need to have, some clear guidance, on both sides, in order to really have it move to the space where we would like to see it, where you'd have a little bit less systemic risk.
yeah. And then I'm going to finish my tangent section here with China.
Yeah.
China. I said that very Trumpian there. So you guys are working with our team here at RCM to deploy some models in China. What's your experience been like? What does the data set look like? What do you guys think of those markets? Any other thoughts? Yeah.
So we've been looking at China for almost a decade now. I feel like it's one of those things where it's another data stream, right? And it's another way for us to diversify our business and potentially develop another product. And China is another market 10 years ago that was very immature.
Yeah.
Term structure didn't really quite exist. And we've been watching it grow. And now it's the liquidity in these markets is incredible. I mean, it's really something to see. It's now globally, opening the regulation has changed and changed quite a bit within just the last year. So we've got more markets coming online. We've got direct access via RCM, which is pretty incredible. We're trying different things to find different trades within a variety of different markets that are available both just direct to China or via RCM. And I see this as hopefully becoming a very big part of our business in 3 to 5 years.
It's fun, some of those markets, right? When you're like building it out and you're like, wait, what is this?
Yeah.
How do I pronounce this? Penephthalephaline?
Well, we've seen, agricultural markets there are huge. The open interest in these markets is like I said, it's unbelievable. I mean, it's 3x what it is in US markets. And, some of that is, I'm not sure who the big players are. A lot of it's prop. A lot of it is what I've been told is retail. A lot of it's banks. Maybe some of it's part of the government, but I do know that there's huge liquidity and there's good trend. And so for guys like us, that's what we want to see. So our systems have evolved over the past 10 years to start incorporating term structure, which did not exist 10 years ago. Within the last 5 years, the term structure within the commodity market was only in 3 months. Now we're starting to see term structure starting to move into more something that we're used to seeing within the United States. So the markets are becoming more mature. And that should allow our models to work a little bit better, as we believe that term structure is, the better predictor of flat price movement. So we want to be able to implement those models in China, and we think that could be, should drive some pretty good returns.
Awesome, guys! Thanks so much. We'll talk to you soon. If I don't see you before you head to, I wanted to say Cartagena, but Medellin. You told me how to pronounce it. I already forgot.
Medellin.
Have fun.
Thanks for having us. Appreciate it.
Thanks, guys. Okay, that's it for the pod. Thanks to Brian. Thanks to Emil. Thanks to RCM China for supporting. Thanks to Jeff Berger for producing. We'll see you next week with Russ Colitis, and week after that with our recording of our live Philly event. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.